I'm just going to say it. There is a risk in real estate investing. Hopefully this isn't a surprise to you because there is a risk in every type of investment. And although risk is often portrayed as this bad thing, I think risk is a necessary component of investing. You take financial risk in search of financial rewards. That's what investing is. The potential for risk and reward fall along a fairly efficient spectrum, meaning that the more risk you take, there is more reward. Flipping is one of the most profitable ways to invest in real estate, but it's also high on the risk factors. When you look at a rental property, the risk is less, but you're probably not going to earn the same kind of cash on cash return or IRR on a rental property that you would as a flip. And the same thing goes for other types of investments, right? Like a bond for a US Treasury is probably the lowest risk, but also the lowest reward of most investments that you would consider. So as an investor, your goal shouldn't be to avoid risk. It should be to take on the right amount of risk for your personal goals and financial situation. And although I believe real estate, when done right, offers some of the best risk-adjusted returns out there, it is important for real estate investors to understand the role that risk plays in their portfolio. This includes identifying potential risks. Like you have to know what the risks are in your investment. Otherwise, you're just going into something blind, and that's more like gambling. You also need to select deals that have the right risk profile for your situation and goals. And then the last thing every investor needs to do is take steps to mitigate risk. Like I said, risk is not your enemy. It's something that you need to be comfortable with to be an investor. So in this video, I'm going to walk you through some of the major risks for real estate investors and how to properly mitigate them. But before we get into that, let me just quickly introduce myself. I'm Dave Meyer, Vice President of Data and Analytics at BiggerPockets and a real estate investor for more than 13 years. And next week, my newest book is launching. It's called Start with Strategy. It's designed to help investors, whether you're new to this or very experienced, craft a personalized real estate investing strategy. Now, if you know anything about real estate investing, you know there's a lot of ways to invest. There's no right answer. There's no one way that works for everyone. You have to figure out for yourself which real estate investing tactics and deals are best suited for you. So if you're interested in building a personalized real estate strategy designed to hit your specific goals, check out my new book. And right now is the best time to buy the book there will probably ever be, because right now we're in the pre-sale period. And during that period, we kind of give you some incentives to buy the book. That includes a free strategy planner. It's normally $30, so it's a really good value. And it's a workbook to actually write out and do these exercises that deliver you a full comprehensive strategy. You also get group coaching calls, an Excel toolkit, all these other great bonuses. So if you want to check out the book, head to biggerpockets.com/strategybook. That's the only place you can get the bonuses. You have to buy it on the BiggerPockets bookstore. So follow the link in the description below or go to biggerpockets.com/strategybook. With that out of the way, let's talk about the major risks to investors. And these are risks for really any investor. And there's different categories of risk. The first is principal loss. So when you invest in something, you invest the money that you put in is the principal, right? So let's just say you bought a house, and we'll use a nice round number. You invest $10,000, right? That's probably not realistic, but I'm just using a real easy number to understand. So there is risk that you lose that $10,000 or part of that $10,000. And that is principal loss. If you invest in something and you walk away with less than you put into it, that's principal loss and is generally considered the worst type of risk, right? No one invests to walk away with less money than they started with, right? Like that's the opposite. You don't want that to happen. There's another category of risk, which is generally less severe, but is also important, which is also called underperformance. You can also think of this as like opportunity cost, which is basically if you invest in something that doesn't do as well as something you could have. So say, for example, you invest in a short-term rental expecting to get a 10% cash on cash return, and things don't go well and you only get a 2% cash on cash return. Meanwhile, bonds right now are yielding 5% cash on cash return. So in that scenario, you could have just bought bonds, which is less risk, and earned a 5% cash on cash return. Now, it's an oversimplification of the situation, but hopefully you understand what I'm talking about. And the last one is inflation risk. And people often overlook this, but by holding money in cash, as we've seen over the last couple of years, there is risk that you will basically just lose money by doing nothing, right? If you just let your money decrease in spending power, that is also risk. And so as an investor, you have to be thinking about these three things. Just as a recap, it's principal loss, which is losing some of or all of the money that you put in to start. Underperformance, which is basically not doing as well with your investments as you had hoped or you could have done with another deal. And inflation risk, which is the risk of doing nothing. And again, these categories apply to all investors, but let's just dig into like what specific specifically in real estate investing can lead to these things. Like, what can go wrong in real estate that leads to principal loss or underperformance? And what are the best ways to mitigate them? So the number one thing that's probably on everyone's mind right now is market risk. Market risk is basically the risk of property prices going down. Now, we've been in a very uncertain housing market over the last couple of years, and although it's been relatively stable in 2023, more stable than I thought it was going to be, there is more volatility and uncertainty in the housing market over the last few years than there was in most of the 2010s, for example, right? That was a relatively linear market that was growing consistently year over year. Now, I think there's more risk of a correction than we've seen. And so that is definitely risk. And this is a relevant thing to think about today. It's also risk in the market of rents going down, right? If there's a big recession, for example, and job losses start to pick up, people might not be able to pay rent, or rents might decline, market values might go down. And so that is all market risk. This is something that probably most people think about when they think about the risk to real estate investing. Market risk is probably the first thing that comes to mind. That said, I think it's important to note that this is far from the only risk in real estate investing, nor is it necessarily the most important, because when we talk about mitigating risk in just a minute, you'll see that market risk is actually one of the easier ones to mitigate. And just as a reminder, there are other ways to make money in real estate besides housing prices. If housing prices go down 2 or 3% next year and you're still making money on amortization or value add or cash flow, it can help offset that. Obviously, you don't want it to happen, but it can help offset it. So how do you mitigate market risk? There's many ways to do it, but I think the number one thing is time. As a real estate investor, time is your friend. The longer you hold on to a property, the less likely it is that market risk impacts your portfolio. On average, housing prices decline about once in every 7 years. And so if you buy in the year that it declines, that's unfortunate. You don't want that. But if you hold on to it for a couple of years, it is very likely that prices are going to recover and probably exceed what you purchased your property for. And so that is the number one way to mitigate risk. And I really recommend people who want to get into the market right now, if you just want to buy a property and hold it for 2 or 3 years, now is probably not a good time to buy real estate. But if you are like me and you're going to buy something, hold on to it for 5 years or 10 years, you're probably going to do okay in terms of the market. And that really helps mitigate risk. The second one is cash flow. There's different ways to think about this. Cash flow helps you earn a return even if prices go down. But I think the real thing to think about here is avoiding forced selling. One of the biggest, if not the biggest risk to real estate investors is selling a property when you don't want to. Think about the great financial recession. If you bought in 2007 and you were forced to sell in 2008, you were probably taking a pretty significant principal loss. But if you could hold on to, say, 2013 or 2014, in most markets across the country, prices rebounded and actually had gone up. So like I said, time is a good mitigant. But the way you buy time is by having cash flow, right? Because if you were taking a loss for those several years, you wouldn't be able to hold on to 2013. You would be bleeding money and you'd be forced to sell faster than you want to. And that is not good. And so having some cash flow allows you to be more selective about when you sell your property. It also brings in money that you can use to reinvest or do all sorts of stuff with. But I think it's really important in terms of market risk that it allows you to bide for time and choose when you sell your property. That's super important. So those are my 2 top tips for mitigating market risk. Intend to hold your properties for a long time and make sure that they cash flow so that you can hold on to them and actually follow that intention to hold on to them. The second risk I want to talk about today, other than market risk, is property risk. So when you go and buy a real estate investing, you're probably hoping that the property you buy is a good one. But sometimes you buy one that maybe is in a bad neighborhood that you didn't really understand, or has a roof that's going to fall apart, or there's structural issues that you just didn't see when you were doing your due diligence. And that is a real risk to buying property, right? You want to buy a good one. So the way I suggest mitigating this, there's a couple different ways to do it. First is build out a buy box. Be sure the type of property that you want to buy. So some people want to flip houses and they're okay with properties that are in bad shape. And so for them, there is property risk, of course, but they're going into it knowing that that's what they want to buy. I think the worst scenario is if you're someone who wants to buy a turnkey property, just buy it and sort of like start renting it out right away. And you don't know that the property that you bought is going to take $30,000 or $40,000 to repair, to get it up to code or something like that. That is really bad. Build a good buy box and do your due diligence, right? On the property itself. Get an inspection, make sure it's a high quality inspection when you do a property risk. You also want to do market research. You don't want to find out later that you bought a rental property in a place no one really wants to live. And one good way to do that is obviously to follow some of this content we make here at BiggerPockets that teaches you about market research. But another good way to do it is finding an investor-friendly agent, right? If you find a great investor agent, they'll be able to tell you what areas of your market or what areas of the country are good places with less property risk. If you want to find a good investor-friendly agent, just go to biggerpockets.com/agent. We match people entirely for free. The third risk that I want to talk about is income risk. Yes, everyone who buys a rental property intends to collect rent, but sometimes there is income risk. There might be risk of vacancy or the non-payment by your tenant or some other thing that happens that makes you not collect the amount of revenue that you were expecting. This is a common risk in real estate, and unfortunately, sometimes there are lapses in your income, but there are good ways to mitigate it. The first is to get very good at screening tenants. On BiggerPockets, we have tons of good tools to help you, but you want to make sure that you're finding tenants that are going to take good care of your property and are in a good and responsible financial position to meet their obligations of the lease. The second is strong property management. Develop good relationships with your tenants based on mutual respect so that you can retain your tenants. I know this sounds shockingly simple, but it's true. If you're just able to keep good tenants, it really, really mitigates income risk. So make sure you're a good landlord. Fix things on time. Be proactive about improving the property and have a good relationship with your tenants to make sure that they stay a long time and they are very happy in your place and will keep good care of it. So that's three. Those are three risks we've gone through so far: market risk, property risk, and income risk. The last one we're going to talk about today is operational risk. And this is one I think everyone overlooks. But real estate, although it's an investment, it is also a business. You are an entrepreneur and you have to run your business successfully, right? If you don't know how to operate a good business, there's a lot of risk because you could buy a great property. You could buy during a good time and tenants can continue to pay as they agreed. But if you don't keep track of your books, if you don't pay your contractors on time, if you don't follow regulations or do your accounting, you face a lot of risk. And so the way I recommend people mitigate operational risk is one is experience. You learn a lot as you become a real estate investor. So if you're new, you may want to consider partnerships, especially if you're new to entrepreneurship or to business in general. You might want to consider for one of your first deals doing a partnership because you can leverage the experience of another investor so that you're not going into something blind. The second thing is outsourcing. If you are not good at bookkeeping or keeping track of finances or property management, outsource those things. I know that means you have to pay money for them, but I promise you, paying someone to do something expertly is going to cost you less money in the long run than you saving money and doing it poorly. So just be a little bit self-aware and understand what things you're good at, what things you're not good at, and outsource the things you're not going to be very good at. The last thing is just to dedicate time. There's a lot made in the media about real estate investing, how it's completely passive. I'm sorry, but most deals aren't. They take a lot of time and they're more passive than a job. That's definitely true. But you can't just buy a property and then do nothing. And so the other way to mitigate operational risk is just to put in the requisite time of being a good real estate investor. And again, I know this sounds really simple, but a lot of people overlook the fact that you need to work on your craft as an investor and dedicate the time to get good at operating your business. So these are just four of the biggest risks. Again, they're market risk, property risk, income risk, and operational risk. And hopefully you can see that they are reasonably good and easy ways to mitigate those risks. Now, these aren't the only risks. And in my book, I cover an additional 6 risk categories. So hopefully you can see from these examples and the other ones in the book that there are risks absolutely in real estate investing, just like there are with every other investment. But if you understand them and learn about them, there are absolutely ways to mitigate them. And remember, risk is different for everyone. It's a subjective thing. And the goal isn't to completely eliminate risk. It's to find deals that take on the appropriate level of risk for you and your financial situation, and then do your best job to mitigate the risks that exist with your personal strategy. If you want to learn more about this, you can check out my book. And remember, if you're going to buy the book, now is the best time to do it when you get all of those free bonuses. If you want to check it out, just head to biggerpockets.com/strategybook. The link is in the description. Thank you all for watching. My name's Dave Meyer, and I'll see you next week.